Good evening, everyone. Welcome to post market report for Sensex for today. Today was Sensex monthly expiry for May. So, the May session for Sensex has been completed, and tomorrow is a festival holiday. So, there is no market tomorrow. The Indian market is closed for tomorrow, and then we have one session in this month, which is a Friday session. Friday session would be the last session for May month, and then we have a weekly off of Saturday and Sunday. Okay, so Sensex monthly contracts got expired today. It was a pretty volatile market. Um, I'm sure very few people might have taken the advantage of uh, both the sides because in the morning there was an opportunity for buyers uh, to take entry, and after around 11 or 11:30, even market gave a chance to the downside, and at the end there was a pullback. End of the day there was a pullback. So overall it was the behavior was sideways. The behavior was sideways, but in fact experienced traders who understand the price action, I'm sure they might have taken uh, advantage of both the upside as well as the downside uh, during the uh, during the daily session. So with that, I would like to uh, add one more example to our series, why retailers lose, part 3. This would be part 3 of a continuous series of why retailers keep losing, and this time I want to take example of directly price. I'm not taking index as an example, but I am taking directly the price chart. This is the price chart, and I'll be directly taking an example from the price chart to point out why retailers get easily trapped, and they take losses while trading intraday, especially when they're trading options. So today we'll focus on the price chart, and we'll take an example of price, how price behaves, and how retailers get trapped in the market with this example. So for this example, I have taken Sensex May 76,000 put option contract. I have taken May 76,000 put option contract. Okay, so on on y-axis you will see the price of the contract, and on the x-axis you will see the timeline of the contract. Okay, and this is your chart, the price action chart. So if you focus yesterday this contract, May 76,000 put contract, was trading around 100 rupees. It was trading around 100 rupees, and the closing price was around 238, and the high of the price was around 325. This was the high, 325, and the closing was around 230, 235 rupees. Open somewhere here around open, low, high, and it closed for yesterday. Today morning at 9:15, when market opened, it opened within this price range. If you see, the May 76,000 put option opened within this price range. So initially at 9:15, if you see it at 9:15, this is the 9:15 candle. There was a upward sweep and a strong sellout, and at around 144 rupees there was a buy. So all the FOMO traders who are looking for buy opportunities might have taken this contract at around 144 rupees somewhere here, and market went up, and they even saw a good profit of around 120 points. 120 points is a very good uh, profit. And then suddenly there was a sellout trapping the buyers. This selling trapped the buyers, the buyers who didn't take profit in their initial entry. And again there was a buying, and again there was a selling. So this market behavior is so confusing in this area. So most of the traders might have got trapped in this area. They might have bought the price came down, they might have exited, again price went up, again price came down, trapping all the buyers. So all these initial buyers, they got trapped when market came down to 93 rupees, because their purchase were on 140 and 170, and market came down to 96 rupees, and all these buyers were trapped. Okay, so why was market able to trap these buyers? Because they were in a hurry to take a position. Market was still playing in the same range of yesterday's price. Market never broke any of the side. It didn't break out on the upside or it didn't break out on the downside. It was just playing around here, and um, FOMO traders took their positions. Trapping those traders, market came down, and all these buyers, most of these buyers will have their stop losses here. So their stop losses would be somewhere here. So market came down to grab their stop losses. These are the stop losses. So market came down to grab all the stop losses over here, because whoever was buying here, obviously they would have put their stop losses, saying that okay, if price breaks down this low, I'll exit the position, sell my position. So what did market do? It lowered the price to around 54 rupees. Their yesterday position was around 99 rupees. Market went down till 50 to 60 rupees, accessing all the stop losses of these buyers. And then market accumulated at the lowest possible price. It accumulated at the lowest possible price, and there was a price recovery. Then suddenly market immediately came down to sweep the liquidity of all the early buyers who had an opportunity to enter in this area. So it took the liquidity over here. Now initial buyers made an entry at around 65 rupees. Market again came down to 77 rupees. Imagine the buyers who might have entered here and price again came back. So psychologically they might be under a pressure to cut their position, because there was a good profit, they didn't take the profit, price again came down, so impacting them psychologically, showing that okay, I may go against you. So most of the traders might have, at the break even, most of the traders might have taken the minimum profit and they might have exited. As soon as these early buyers exited, market again took their liquidity and made another higher high. It broke the previous high, making a higher high. So it broke this high and made a higher high. Okay. Now the buyers who might have missed this entry opportunity, by seeing this breakout, they might have made an entry at 150 rupees. You can see this level is at 150 rupees. As soon as they made an entry, buying entry of 150 rupees, market came down. Again, it came back to 60 rupees. Imagine the pain of the buyer who might have entered the market at 150 rupees and it came to 65 rupees. It's like taking almost 60% of the loss. So they might have experienced a 60% of loss in this case. But as soon as when market took the liquidity of all these levels, market regained its momentum and it broke even this high. It broke even this high. It made another high at around 270 rupees or 267 rupees to be precise. It went up till 270 rupees. You can see that this was the initial buyer's entry. Market again came back to 77 rupees. Again market came back to 65 rupees. But it never broke this low. This low was never broken. Low was low, never got broke. This low never got broke. So only experienced traders might have held their positions when price came over here and over here. You can see once price came to 65 rupees, it again went to 280 rupees. It was a straight profit of around 150 to 160 points. Imagine the multiplier. If anyone would have entered with a 10 lot entry, 10 lot into around 20 20 260 points, that would have given him around 26,000 profit in this moment for this one single day. And then there was a profit booking, and at the fair price it closed around 131. So the guys who had entered over here and who didn't book the profit here, they got some minimal points from around 80 to 82. It moved around 130. That means they were still at a 50-point profit here, minimum profit. But the experienced traders who took an entry over here and who exited here, they might have capitalized more from the market. So how many times did market test the retailers? Market gave an entry. Yes, first yesterday's retailers' confidence was broken when price came down. These retailers were discouraged, made them giving out their positions. And today, when retailers made an entry over here, market again came back here, testing their patience and we can say mental strength. Once it went back, they would be happy that price is going up. But again, there was a pullback. Again, market retested again at the same level of around 65 rupees. Again, the traders who were in positions, they would have mentally got stressed over here that they might have missed a good opportunity of booking profit here. But there was no break of structure to the downside. There was no bearish break of structure to the downside, and market immediately pulled back, giving a nice profit of around 260 points. So the experienced traders might have taken good advantage of this movement, But when it comes to the retailers or inexperienced traders, they might have got scared when market pulled back. The market pulled back almost one, two, market pulled back three times within the entire session. So you can imagine it is very easy for retailers to take losses and exit the market with such kind of market behavior. So in this parts 3 session of why retailers lose, we will make a good point that market structure due to lack of market structure understanding like what is BOS, break of structure, and chalk, that is change of character, is also one of the major root cause why retailers end up taking loss after entering a profitable position. So this was a highly profitable position, but if they are lacking the important knowledge of what is break of structure and what is change of character, they might have easily given up their position to the market and closed their position for it a minimal profit, losing out losing out a good opportunity of making money in this moment. So with this, I close this session. I end this video here. So again, tomorrow is a market holiday for India. I'll try to make um, a video on the crypto market, Ethereum or Bitcoin for tomorrow. Till then, have a wonderful evening and happy trading. So see you guys tomorrow. Thank you.